Hey friends, Harvey Keene Properties LLC, West Valley real estate agent. Hey, breaking news, Donald Trump today proclaimed in a speech that he is going to demand lower interest rates. So let's talk about that. If you've been following my page, you might have seen a video I posted on Sunday, the day before the inauguration. And the title of that video was kind of tongue-in-cheek. It was, will Donald Trump make interest rates great again? And the reason I posted that video is because I'd had a lot of conversations recently with consumers that had the perception that everything is automatically going to get great interest rate wise. Rates are going to drop because Donald Trump is our new president, and Donald Trump's going to fix the economy. He's going to fix everything. He's going to fix housing. And everything is just going to be wonderful. And so the point of that video was explaining a little bit about how interest rates work and how Donald Trump doesn't have this magic wand that's going to make interest rates great again. But today he came out and said that he's going to demand that interest rates drop. Well, how's he going to do that? What I said in that video, what we don't want to hear is we don't want to hear Donald Trump come out and say that. And it's like almost like a prediction. I kind of had a feeling he was going to, kind of had a feeling I'd have a follow-up video on that. And lo and behold, what's that, 4-5 days later, here we are. So how does Donald Trump affect, how does he make or demand that interest rates become lower? And how's that going to work? Okay, so so if he goes to the Federal Reserve and says, drop the federal funds rate, the Federal Reserve is independent, and they're supposed to be nonpartisan, and they're not supposed to be swayed by the government, by whoever's in charge. They're supposed to be sort of market dependent, and everything that they do is supposed to hinge on the economy and economic reporting and all that stuff. So let's say Donald Trump pressures the Fed to drop the federal funds rate. Well, as we all know, that does not impact mortgage rates. And the federal funds rate has very little to do with at the consumer level. So you and me, our mortgage rates, our car loan rates, our credit card rates, the Federal Reserve doesn't have much to do with that. What does affect our mortgage rates is longer term bonds, specifically the 10-year Treasury yield. How will Donald Trump demand that to drop? And how will he affect that? It's all based on supply and demand. So private capital, investors, institutional investors, hedge funds, pension funds, large banks, sovereign wealth funds, other countries, that buy our debt. The more demand there is in the bond market, the lower the yield or the interest rate, the rate of return. And the lower the demand, the higher the rate of return. So how does Donald Trump, how is he going to demand that interest rates drop? How is he going to affect demand in a private market, in the free market? Well, my suspicion, and I hope I'm wrong, my suspicion is that he's going to demand a fifth phase of quantitative easing. And if you don't know what quantitative easing is, look back on some of my prior videos. I discuss it pretty heavily. I'm not going to go into that much depth on this video. But basically, quantitative easing is where the government runs up the national debt by printing dollars. They inflate the supply of currency, which devalues the dollar, creates inflation, And what they do is they inject that capital into the bond market or the secondary mortgage market, and it creates that artificial demand because the government becomes a guaranteed purchaser of those bonds and those securities. And when there's guaranteed artificial demand, that artificially presses rates down. And the problem with that is the Federal Reserve, they've already done 4 phases of quantitative easing: 2008, 2010, 2012, and 2020. And that artificially lowered interest rates into the range of 3 to 5% for the better part of 12 years. And the Fed was pretty much almost the only investor that was buying those bonds, those mortgage-backed securities on the secondary mortgage market. And by creating that artificial demand, they suppressed rates to like historic all-time lows artificially. And in 2022, the Federal Reserve came out and stopped. They said, effective immediately, we're not buying mortgage-backed securities anymore. We're not artificially propping up the market and artificially suppressing rates any longer. That was March of 2022. And within 2 months, interest rates went from 3% to 5%. And in May of 2022, Fed came out and said, hey, not only are we not buying these assets any longer, we're also going to start tightening, which is quantitative tightening, which is where they divest their portfolios. They sell their portfolios of these assets into the open and free market. And, they over the course of 4 iterations of quantitative easing, the Fed, their holdings reached $2.7 trillion in mortgage-backed securities. That doesn't even include treasuries. This is mortgage-backed securities. And since they started their tightening cycle in May of 2022, they've only sold off $500 billion. Now, institutional investors, people whose job is, or institutions whose job is to make money on their money, they like 2 things. They like a strong rate of return on their capital invested, aka interest rates, and they also like to buy stuff for cheap. So buying investments or assets at a deep discount. Well, all of the Fed's holdings that they're trying to sell off to investors, they're all paying a rate of return of like 3 to 5% on an annual basis. So what investor is going to want to buy that when they can just go to the secondary mortgage market and pick up portfolios of mortgages that are paying 7%? No investor in their right mind would do that. So the Fed has to discount the portfolios that they're divesting off of their balance sheets, like at a significant discount. And I read that they're selling them at like 60 cents on the dollar. And so the investors have a choice: buy those cheap portfolios that pay a low rate of return, or pay the market rate and receive a market rate of return, 7%. So as long as the market is free and the government is not injecting capital into the market, I don't see how interest rates on their own could get back down to historically low levels. They can't. And I said on a few of my videos recently, the new normal is the old normal. The old normal is the new normal. Before the financial crisis of 2008, interest rates were 6 to 6.5%. We're back to 7 right now, tad bit higher. But my thought is that we're probably going to range between 6.5 and 7.5, and there's just going to be a lot of volatility, and it's just going to be up and down in that range. They might dip down to 6. They might dip down just below 6, into the high 5s. My thought, though, is that they'll probably shoot right back up. Now, this is if the market is free and the Federal Reserve is not injecting capital into the bond market or the mortgage-backed securities market, aka secondary mortgage market. Now, if Trump pressures the Fed to enter a fifth round of quantitative easing, mortgage rates will drop. But at what cost? Great. Like maybe we get 5% mortgages again. Maybe they're like 4.5%. I don't know. It's awesome. Like for consumers, you know, me and you going out and refinancing or purchasing a home, we get a lower interest rate. But what problems will surface as a result of that? I mean, because they don't have the money to do it, so therefore they got to print dollars and inflate the supply of currency on the market in circulation. So what happens to our dollar? Our dollar goes down in value. And when our dollar goes down in value, what happens to the cost of goods, services, and assets? They go up because your dollar is worth less. It's been 3 years since the Fed stopped buying bonds, and almost 3 years since they started their tightening phase, which is unloading their balance sheets. They've only unloaded $500 billion off their balance sheet, so they're still holding $2.25 trillion. They still got to unload that, unless Trump successfully pressures the Fed into re-entering another phase of quantitative easing, in which case that balance sheet value is going to grow, and so will our national debt. My belief is that if the government keeps their hands off of the free market, slowly but surely the market will reach some equilibrium and balance and return to sort of a healthy economy. But it takes time. And if Trump does sort of instigate another round of quantitative easing, then that's just going to kick the can down the road, and it's just going to prolong the process of returning to a healthy economy, both, you know, real estate, mortgage, and otherwise the broader economy. So yeah, I mean, who doesn't love low interest rates? Like, great. We'll benefit in terms of being able to buy and sell homes, and buyers be able to get, you know, more affordable payments and better interest rates. And like, I'm a real estate agent. I only get paid if I sell a house, right? So obviously I'll benefit from lower rates. But I'm more concerned about having a healthy economy that my children will inherit. I like to think of our economy during the 12 years that the Fed was pumping capital into the bond market and the mortgage-backed securities markets. I like to think of our economy as kind of like was like a heroin addict, and the heroin was cheap and easy money. It's cheap, you know, low interest rates. And while our economy was high on cheap money, like, it was party time, right? Everybody loved it because it was you buy a lot more house for your money, lower interest rates and such. But I mean, in the meantime, what's happened to inflation? What's happened to the value of our dollar? What's happened to the government debt? And in 2022, the Federal Reserve took away the economy's heroin. So naturally, the economy went into withdrawals, and we've had withdrawals from cheap money. We've had withdrawals for going on 3 years now, and finally things are starting to feel like they're going to turn around. And there's a recognition that like 6.5% to 7% interest rate is kind of a normal rate, historically speaking. And I don't know about any other real estate agent, but I'm getting a lot more calls and having a lot more conversations with consumers looking to do something this year. And so, yeah, if Trump pressures the Fed to do something to drop rates, sure, that's going to move a lot of business forward, and it is going to stimulate the real estate economy in the short term. But eventually, the government can't just do that for forever. All it is kicking the can until the next time. So Anyway, the point of the video I made on Sunday was Trump doesn't have a magic wand, and you don't want him to have a magic wand. And the last thing that we want to hear from Trump is that he's pressuring the Fed to enter a fifth round of quantitative easing, and that sounds like that's sort of the direction we're going. So, I don't know. If you have any thoughts or criticisms on this video, comments, feedback, whatever, drop me a comment. If you are thinking of buying or selling a home, or want to talk about the local real estate market and why I think it's headed in the right direction, or if you just want to know what your house is worth, send me a message or give me a shout. 602-295-0890. Once again, my name is Harvey Keene, Keene Properties, West Valley real estate agent. Have a wonderful day.